Welcome to this exclusive, unparalleled investment opportunity, shared only with a few select investors. From everyone here at Terra Equity Group, we want to thank you for your time and interest in partnering with us. To skip ahead of the line at any point for a personal overview, simply connect with our team using the information at the end of this video. Before we begin, it is important to note that the information being shared here involves investment opportunities which are regulated by and in compliance with certain SEC rules and guidelines. The information that we are sharing is based on a number of assumptions and hypothetical scenarios, and past performance does not guarantee future results. Like any investment, there are risks involved, and it is important that you are aware of those risks. In this video, we will be reviewing Terra Equity Group's approach to investing in commercial and multifamily real estate. As we work with investors and potential investors, we like to first make sure that as partners, we are all on the same page and are aware of the market we are performing in. Commercial real estate is a low volatility, high return investment versus other equities such as stocks, which are high volatility, medium return investments, or bonds, which are low volume, low return investments. With commercial real estate investments, you're investing across multiple markets, and each market is very localized as far as how it behaves in various real estate cycles. It's important to remember that there isn't a national real estate cycle, at least not like those found with stocks and bonds, which tend to have more market-wide cycles. And unlike other investments, like stocks and bonds, real estate has the tendency to hedge for important investment performance factors such as inflation, while simultaneously offering a passive income, tax benefits from asset depreciation, and cost segregation. For this reason, along with a legacy of investment performance results, we are confident in the opportunities we bring to our partners. If you are independently controlling your IRA or your 401k, for example, then it might be wise to consider commercial real estate as a similar asset class, as opposed to stocks, bonds, cash, and savings for the reasons listed. Obviously, commercial real estate investment is an opportunity that has to match well with your own financial strategies. So our team is ready to assist new or seasoned accredited investors alike in such unique opportunities. Multifamily real estate is merely one asset class within the commercial real estate investment category, but it's important to note that we do invest in other high-performing asset classes, those that enjoy high returns such as retail, which performs particularly well with returns of nearly 9.44%. In general, based on research we reviewed, as well as with decades of experience in delivering investments to their fullest potential, it's reasonably safe to expect preferred returns at around 8%, or a 15% total rate of return if we factor in depreciation of the property and other indirect investment gains that our strategies help to grow. As shown here, there are three primary benefits that you get from multifamily real estate. First, you protect your taxes. Second, you preserve the capital that you have while also growing it. And third, you have the added option of earning passive preferred cash flow. This last point, earning additional preferred cash flow, is an important differentiator when reviewing your investment portfolio strategy and any investment partner you align with to help grow it. Why is multifamily real estate important? Because it is notably and reliably resilient. No investment is immune to risk. And yet, while all other real estate asset classes took a hit with the recent pandemic, when fewer travelers were staying in hotels, when offices nationwide were closing down, and while people were canceling their retail center leases, multifamily nevertheless thrived. In particular, the sort of qualified properties that we target did remarkably well throughout the course of 2020. And this is by design, because we specifically target properties in emerging markets that are themselves attracting the caliber of tenant that statistically has a better chance of surviving common and uncommon market-wide swings. These migrations of qualified tenants become an important tactical consideration in review of an opportunity. The Southeast is currently experiencing several of these qualified tenant migrations, and this is good news for multifamily units in these areas. Coupled with a booming population of Gen Zs that are now entering into the rental market, and these areas now become hotspots for investment qualification by our review team. Florida in particular enjoys 2 of the top 10 cities that remain attractive to such tenant migrations, which is why a good portion of our investments are in the Florida market. That said, our team tracks all qualified emerging market opportunities, and from these, we currently manage more than 2,300 units, almost $183 million in assets, across 7 states. In our experience, the hallmark of highlight migrations is a combination of population growth, job growth, and the sort of economic development support wherein development committees have plans and incentives in place to help drive favorable conditions, which in turn drive local business growth. The multifamily emerging market cycle, shown here, shares characteristics found in other real estate markets, which move in similar cycles. Our approach to this cycle is that it is ultimately divided into 4 segments: Buyer's Market 1 and Buyer's Market 2, Seller's Market 1 and Seller's Market 2. Our approach is to catch properties in these emerging markets between the Buyer's Market 2 phase at the trough of the wave up to the Seller's Market 1 phase, then close out the property while it has significant favorability up to and in the Seller's Market 2 phase. In this, we've captured a significant amount of appreciation, while still leaving room for the next party to see desirable investment opportunity. Of course, market cycles are present in all markets, but most emerging markets tend to have lower troughs and higher peaks. So when the opportunities are good, they're particularly good, and when they're hard-fought, they're particularly hard-fought. Emerging markets allow you to capitalize on the gain, but they can be very market-specific, and this allows a firm like ours, which operates across multiple emerging markets, to always have some qualified opportunity to get into or out of. This concludes our brief overview of this aspect of the investment and partnership opportunity with Terra Equity Group. However, we encourage you to continue to watch the other videos that our team has created in this series, as they each outline key strategies and approaches we employ to help assure your capital growth. If you would like to reach out to our team, simply call us at 954-987-6879 or email us at info@terraequitygroup.com. You can also visit our website at any time by heading to www.terraequitygroup.com. Again, our team at Terra Equity Group would like to thank you for your time, and we look forward to discussing this opportunity with you in more detail.